Gold is at an all-time high. Silver making steady gains, and markets seem crazy. So, is this the time to sell? Is there ever a time to sell? We know with fairly accurate certainty via history over time that the value of silver and gold rise due to inflation. Basically, the dollar is devalued and it takes more of it to buy silver and gold. We know that therefore, in 5 to 10 years, the money we hold in physical assets will rise as the dollar weakens. The question is, does it rise enough versus comparable places to park your assets? Another question is, if you were to sell, what plan do you have to move the gained money towards? Selling for the sake of selling is impulsive, but with a logical path, it is intentional. More on that in a moment. We need to understand a couple of concepts in depth before we can assess if this is a good time to sell metals or if we should hold them. The first element we need to identify is human behavior. To understand one's self is one of the most beneficial things that you can do for your finances, as you will be able to make distinctions between impulsive behaviors and intentional behaviors. Some financial psychologists and researchers estimate that at least 50 to 80% of market activity is influenced by investor psychology, sentiment, and emotion-driven decisions, especially during volatile times. If you know the name Robert Shiller, he's a Nobel laureate, a Yale economist who predicted both the dot-com and housing bubbles, and he's shown that irrational behavior and social dynamics often drive bubbles and crashes more than fundamentals. Impulsivity and intentionality represent two fundamental different modes of human behavior, each rooted in distinct psychological and neurological processes. Impulsivity is reactive and often emotionally driven and typically arises without forethought and is sudden desire to act on a feeling. Whether out of fear, excitement, desire, or stress, it bypasses the careful reasoning in favor of immediate gratification, which can lead to short-sighted decisions and regrets. On the other hand, intentional actions are deliberate and goal-oriented. They emerge from conscious thought and reflection and planning. One of the things unattainable by most animals is the escape from impulsivity. Where impulsivity is fueled by the present moment, intentionality is grounded in the future. It considers consequences, aligns with values, and often requires restraint and discipline. Impulsivity reflects our instinctual wiring, the part of us still governed by survival reflexes, while intentional behaviors reflect the uniquely human capacity for self-regulation and long-term thinking. The tensions between the two is what shapes everything from personal finance habits to relationship dynamics and even large-scale societal outcomes. In essence, while impulsivity may reveal our raw human nature, intentionality expresses our potential for wisdom and growth. If you're deciding if this is a good time to sell your gold or silver, the first thing you need to do is understand yourself so that you know you're acting with intention and not impulsivity. So here's the power of intention. The largest study of millionaires ever conducted is called the National Study of Millionaires. The comprehensive research involved over 10,000 millionaires, making it the most statistically significant project of its kind to date. The study aimed to uncover the behaviors, characteristics, and mindsets that contribute to financial success, challenging common myths about wealth accumulation. Here are some key studies from the findings. Did you know that a significant majority, 79%, of millionaires did not receive any inheritance from family members, which underscores the importance of personal financial habits compounded with time over inherited wealth? Did you know that approximately 75% of millionaires attributed their financial success to regular, consistent investing over time, which is an intentional action, rather than relying on high incomes or single stock investments? Did you know that while many millionaires graduated from public state schools, 88% of these held a college degree and 52% had earned a master's or doctoral degree, highlighting the role of education in wealth building? but it's definitely not the only thing you should consider. Did you know that many millionaires practice frugality, with 93% using coupons or other saving methods, and a significant portion spending modestly on dining out, demonstrating that wealth accumulation often involves disciplined spending habits? And here, according to that study of millionaires, are the top 5 careers of millionaires. 4 of these make sense. One of them will shock you. Number 1 is an engineer. Makes sense. Calculated and consistent. Engineers are number 1. Number 2, accountant, CPA. That makes sense. You know numbers. Numbers are your thing. You do numbers. Very, very significant. Number 3 will catch you off guard. Number 3 on the 10,000 millionaires surveyed when it comes to a industry of employment was teacher. Holy cow. Yes, that means people making not a lot of money are number 3 on the list. And why is that? Well, when we got into the research, what it means is that we found people that are frugal by nature, that find a way, that are extremely disciplined and regimented, and that just know how to make things work because they have to do it day in and day out. So teachers are number 3 on the list, which is above management positions, and number 5 on the list, attorneys. That's crazy. So yeah, even teachers can do this, which means you can do this. Now that you understand human behavior and its impact on your financial path, hopefully you can assess yourself to understand if the impulse of seeing your assets like gold at a high and wanting to sell has any intention. To derive intention from this opportunity, you must assess possible alternative places to park your money to see if that is worth the pivot. We know we can park our physical assets like gold and silver right where they are. That's plan A, and it's a great plan A, as we know our money is safe and should grow in value over 5 years beyond what banks offer you to park your money with them. Doesn't mean that should be your revenue grower, though. We know that cash over time loses its value, so we know that's not the move. Well, how about debt? Well, compound interest works both ways, my friend. It can be a financial blessing if your stock portfolio compounds interest, but it can be a nightmare if your debt compounds interest. The math works the same, whether it be negative or positive. So if you have debt, you can wipe out your debt with metals, and it is a solid and intentional thing to do. I'm not a financial advisor, but the logic is right there in front of you. If you are paying interest monthly, you are paying above sticker price for things you borrowed money to purchase. This being said, yes, if you have debt, pay that off today. That's interest. That's compounding that you don't need in your life. So take it, do that. That's definitely something you should consider. What's another option? What about compound interest in the positive offered in assets like mutual funds? This is a solid idea. Mutual funds that track indexes like the Dow Industrial tend to find their way to the black over 5 years. For instance, the S&P 500, a benchmark for large cap US stocks, has delivered positive returns on approximately 79% of 5-year periods from 1928 to 2023. Similarly, the Vanguard Total Stock Market ETF, VTI, for example, which tracks the broader U.S. stock market, has held a 14.52% return over the past 5 years of 2024. These are index funds that track those indexes. This means over time, with compound interest, you can make a large sum of money that gold and silver cannot, mostly because the equivalent of compounding cannot be obtained with physical assets. If metals could compound, that would be the equivalent of having 10 gold coins and then it magically compounding to 12 gold coins. That doesn't happen in physical assets, which is why diversity is very important. This being said, good index funds are an option, but you need to note that any growth over initial investments, if taken out, will be taxed as income unless it's housed in a tax-sheltered option like a Roth IRA. So let's take a look at some charts to show you. Here's an investment calculator, very simple. We're going to start off with $20,000, and we're going to say that we do this for 10 years, and your annual contribution is going to be $1,000 a month, return rate 6%, which, that $1,000 a month can be a lot for some folks, and that's okay. These are just numbers that we can fluctuate. And I would actually encourage you to get on one of these and fluctuate your own numbers to see kind of what you're looking at. We see here results. We have an end balance of almost $200,000. Our contributions would be $120,000, which shows you that the interest is almost a third. It's 29% growth right there. If it's just 6% return rate, which I would imagine it would be closer to 8 being the low and 12 being the high for an average. We threw in 6 just because that's a easy low number to give you a very conservative estimate. So if you see your accumulation schedule here, right there, you see how the interest grows from year to year. And if you were to do this for years on end, you would actually be able to sit on the couch and make money as your interest would be able to fund your lifestyle. Here's another one right here. We have 20,000. We're doing 10 years, and we're only doing $100 a month. We notice it's going to be a lot smaller, right? So we have an ending balance of $52,000, which is actually not bad. We've contributed $12,000 with a starting amount of $20,000. So the interest right there is right at $20,000 as well. So as you see, we have 40% interest in this particular pot. And if you were to use this, say you have a brand new vehicle and in 10 years you want to buy a new vehicle, you would have put in $20,000 and your interest would have been, $12,000 on top of the 20. So you're at $32,000. You make $20,000, and so you can buy a $52,000 truck for and pay it cash, by the way, and have paid that $32,000 for that $52,000 check or truck. That's not a bad option there. There's your accumulation schedule there. And when we go to our third idea here, $20,000, 15 years. So we've added time because time is everything. The same $100. So we add 5 years. And notice we've gone from 50 to 76, which is crazy. So we ended up spending $38,000. We're at 50% perfectly at $38,000. So we have doubled our money right there. How crazy is that? When you add time to compound interest, that is the key. So if you're to start today, you're in good shape. And as you see down here, year 15, you make $5,000. That's crazy. So that is a really, really cool thing to look at when it comes to investing as an option to diversify some of those precious metals if you are trying to sell. And all I'm trying to do today is not to tell you to sell or buy. What I'm trying to do is give you the options so that you can make the best decision for yourself. You need intention before you just go out and do things. Hopefully this will provide some of that. As you can see, this is an amazing long-term solution as the compound interest over a long time equals a significant amount of money. Remember that all gains would be taxed as income, but as you can see, it's not a bad option as long as you're intentional about this and it is exactly what you want to do with your money. I know already in the comments, many of you are thinking about the markets tossing and turning weekly, and yes, you are correct. But did you know, as of June 2021, retail investors accounted for approximately 10% of daily volume on the Russell 300, which encompasses about 98% of all U.S. publicly traded companies, just 10%. This figure had previously peaked at 15% in 2020 during the surge of interest meme stocks like GameStop and AMC Entertainment, driven by factors such as lockdowns, boredom, and increased savings. In comparison, institutional investors such as mutual funds, pension funds, hedge funds, things like Vanguard, Fidelity, you name it, typically dominate the remaining 90% of trading volume. These entities manage substantial assets and execute large-scale trades, often utilize advanced trading strategies and algorithms. This being said, if 90% of volume trading is happening because of funds held by institutions like BlackRock and Vanguard, when the market moves up and down, it's not because citizens and their faith in the market, it's because these fund managers who now own large percentages of most of the top companies that they not only have representation on their board, but they also are privy to information in these positions to pump and dump stocks in their companies that cannot be matched by us. I have assets in the market and do not blink an eye in turmoil such as right now. Why? Well, because I know these private companies want to grow their businesses and influence. Mutual funds, in my perspective, are long play assets as noted. The more time you have, the more interest that compounds. As you can see, the answer to the question, should you sell gold or silver, is only if there is a better solution than gold or silver for your individual financial path at the moment. There could be, but it has to be an intentional choice based on the best inputs you have and not an impulsive choice such as the fear of missing out on a market peak. If you have debt, you should consider heavily how compound interest works against you. If you have time and no debt, you should consider long-term options with compound interest. If you want security and privacy, keep silver and gold right where it is and figure out what the ratio should be of how much you have in this versus how much you have in something that compounds. Thank you for joining me today. Hope you've enjoyed this video, and I hope, as always, you remember to stay classy and current with the culture of currency.